Welcome. This is Jaguar Consultancy, and we're going to be taking you through a deep dive into a massive multinational company that's one of the key players of the oil industry, Chevron. Chevron Corporation is a leading American integrated energy company and one of the world's largest oil and gas producers. Chevron's history. Chevron began in 1876 with California's first commercial oil discovery and became independent after the 1911 breakup of Standard Oil. It expanded globally in the early 20th century with key discoveries in Bahrain and Saudi Arabia and the creation of Caltex. Post-war, the company grew rapidly, building its brand and expanding into petrochemicals. From 1980 to 2001, major mergers like Gulf Oil and Texaco established Chevron as a global energy leader. Today, it continues to grow while investing in lower carbon technologies and energy transition initiatives. Building the base of the company is its core foundation, the Chevron Way. This is a set of values and principles framing their philosophies and guiding their decisions. Chevron's mission is to develop the energy that improves lives and powers the world forward. While this positions the company as human-centered, it lacks specificity and measurable commitments. There are no clear targets, timelines, or defined energy direction. Additionally, it does not address energy justice, particularly in high-risk operating regions such as Nigeria and Kazakhstan. Its vision is to be the global energy company most admired for its people, partnership, and performance. This framing is clear but inherently vague and benchmark-driven. It does not define key stakeholders, and more critically, it omits any reference to climate transition or decarbonization, which are now central to the energy sector. Chevron's core values include integrity, trust, diversity and inclusion, operational excellence, high performance, and partnership. While operational excellence is well integrated into systems, the broader values lack clarity and accountability. Terms like trust and partnership are not operationalized. Notably, sustainability is absent as a core value, indicating a misalignment with current ESG expectations. Chevron's key personnel. Chevron is led by CEO Michael Wirth, who oversees global strategy and capital allocation. Core operations are split between upstream, led by Clay Neff, and downstream and chemicals, led by Brand Fish. The company's energy transition is driven by Jeff Gustafson under New Energies. Financial and legal oversight come from CFO Amir Bonner and Chief Legal Officer Howard Pate. Supporting roles include Mark Nelson, Vice Chairman, Andrew Walls, DMNC, Ryder Booth, Technology, and Board Member John Hess. Chevron's special analysis.
Now let's look at the political and legal factors affecting Chevron. There are both opportunities and threats. The easing of Venezuela's sanctions allows Chevron to resume operations and boost production in the short term. However, geopolitical tensions, especially between the US and Iran, create major risks. The Strait of Hormuz handles about 20% of global oil supply, so any disruption can affect prices and supply. Government policies are also mixed. Tax incentives support clean energy investment, but stricter environmental regulations increase costs. Moving to economic factors, oil price volatility is one of the biggest drivers of Chevron's performance. Lower oil prices caused a significant drop in net income in recent years. Although rising geopolitical tensions may push prices back up. At the same time, Chevron achieved strong production growth in 2025 and continues to benefit from cost advantages in the Permian Basin. However, inflation remains a challenge, increasing operating costs. Demand is also uncertain, with mixed forecasts and the rise of electric vehicles creating long-term pressure on oil consumption. Next, the sociocultural factors. Electric vehicle adoption is a major threat, especially in developed markets, as it reduces fuel demand. However, developing regions still show growing demand. Reputational issues are also important. Concerns about environmental practices can affect public trust, but strong sustainability efforts can attract investors. Workforce trends are shifting as well, with younger talent preferring greener industries, creating competition for skilled workers. Finally, remote work has reduced commuting, leading to lower long-term fuel demand. Technology creates many opportunities for Chevron. The company is using AI and advanced data analytics to improve efficiency and increase production, especially in the Permian Basin. Chevron is also investing in future technologies like carbon capture, hydrogen, and biofuels to support energy transition. Digitalization, including automation and IoT, improves safety and operational performance. However, rapid advancement in renewables, energy, and battery technology pose a threat by reducing long-term demand for fossil fuels. Finally, environmental factors. Climate regulations are a major threat, as carbon taxes and strict policies increase operating costs and may even force refinery closures. Geopolitical disruptions like the Strait of Hormuz crisis can raise oil prices, benefiting profits but may also harm global demand if prolonged. Extreme weather events also pose risks by damaging infrastructure. On the positive side, Chevron is investing in lower carbon solutions and has set long-term emissions goals. However, ESG pressures and stranded asset risks remain key challenges moving forward.
In the short term, performance is highly dependent on oil prices. At $70 to $100 per barrel, Chevron delivers strong cash flow below $60 and margins tighten. The $53 billion Hess acquisition strengthens its position in Guyana's Stabroek block. At the same time, Chevron continues divestments to focus on high-return assets. In the medium-term outlook, demand in OECD markets will decline, but Asia and petrochemicals will sustain global demand. Gas and LNG are expected to become major profit drivers. Regulatory pressure, especially in the US and EU, will increase cost burdens. Chevron's acquisition strategy positions it as a key industry consolidator. Now looking at Chevron's strategic group, these are the firms that represent Chevron's core strategic group, competing across scale, global operations, and the pace of energy transition. Its closest competitor is ExxonMobil. ExxonMobil is significantly larger, with a market cap of around $622 billion versus Chevron's $370 billion. It has a strong upstream presence, particularly in the Permian Basin, and plans to double output to 2.3 million barrels per day by 2030. Shell is another key competitor, with a market cap of about $224 billion. Its strength lies in LNG and more aggressive renewable investments. It also has stronger ESG positioning, particularly with Scope 3 targets, allowing it to compete with Chevron in both traditional energy and in the transition narrative. BP, with a smaller market cap of around $99 billion, differentiates itself through its focus on low-carbon energy and sustainability. Rather than competing on scale, BP positions itself to attract ESG-focused investors. Lastly, Total Energies, with a market cap of about $187 billion, is expanding across oil, LNG, and renewables. Its diversified energy portfolio allows it to compete in both conventional and emerging energy markets. Chevron operates as a highly integrated, capital-intensive energy company, driven by strong upstream operations and supported by stable downstream and chemical segments while gradually investing in lower carbon solutions. Chevron's partnerships, including joint ventures, acquisitions, technology providers, governments, and suppliers, form a global ecosystem that enables large-scale operations and efficient risk management. Chevron's key activities span the full energy value chain, from exploration and production to refining, marketing, and investment in low-carbon technologies. Chevron's key resources include its global oil and gas reserves, extensive infrastructure, retail network, skilled workforce, financial strength, and established brand. Chevron's value proposition relies on delivering reliable energy supply through an integrated model while balancing current demand with investments in future energy solutions. Chevron builds customer relationships through long-term contracts, strategic partnerships, loyalty programs, and tailored technical support. Chevron serves diverse customer segments, including industrial clients, governments, national oil companies, and retail customers. Chevron utilizes multiple channels, such as direct contracts, distribution networks, retail stations, digital platforms, and trading systems to efficiently reach its markets. Chevron generates revenue primarily from oil and gas production, refined products, chemicals, joint ventures, retail sales, and long-term LNG contracts. Chevron's cost structure is dominated by feedstock, operating expenses, asset depreciation, and capital expenditures, reflecting the scale and complexity of its operations. Now moving to Porter's five forces, starting with competitive rivalry, which is high. The industry is dominated by a few super majors like Exxon, Shell, and BP, competing on cost, scale, and efficiency in a largely undifferentiated market. The threat of new entrants is low. High capital requirements, technical expertise, and regulatory barriers create a strong entry barrier, giving incumbents like Chevron a structural advantage. The threat of substitutes is moderate to high. Renewables, EVs, and alternative fuels are growing, especially in developed markets, but oil remains essential in sectors like aviation and petrochemicals. The bargaining power of suppliers is moderate. While oilfield service firms have some influence, Chevron's scale and long-term partnerships provide strong negotiating power. Bargaining power of buyers is also moderate. Industrial buyers have leverage through contracts, while consumers have limited short-term options, though this is shifting with EV adoption.
On to the financial statements. This is Jaguar's financial analysis of Chevron over 5 years. Chevron's revenue increased significantly from 2020 to 2022, peaking at $235.7 billion due to strong oil prices and post-pandemic demand. However, from 2023 to 2025, revenue declined as prices normalized. This pattern highlights Chevron's dependence on commodity cycles rather than purely operational expansion. Chevron's net income rebounded strongly after a loss in 2020, reaching a peak of $35.5 billion in 2022. However, profits declined sharply from 2023 onward, even as revenues remained relatively high. This indicates that profitability is more sensitive to cost increases and margin compression. Chevron's total assets remained relatively stable from 2020 to 2024. In 2025, assets increased sharply to $324 billion, indicating significant capital investment or acquisitions. This suggests a strategic shift towards expansion. Revenue growth was strongest in 2021 and 2022, driven by external market conditions. After that, growth turned negative and remained weak through 2025. This pattern reflects a correction phase following unusually strong performance. Net income growth shows extreme volatility compared to revenue. After very high growth in 2021 and 2022, earnings declined sharply in the following years. The magnitude of decline is much greater than the revenue changes, indicating margin compression. This highlights rising costs and reduced efficiency. Chevron's cost structure improved significantly from 2020 to 2022, allowing margins to expand. However, from 2023 onward, costs increased as a percentage of revenue. This led to declining net margins despite relatively stable revenues. The trend suggests sustained cost pressure rather than temporary fluctuations. Chevron's current ratio shows a gradual decline from around 1.0 to 0.86 in 2025. This indicates that current liabilities exceed current assets in recent years. While this suggests limited short-term liquidity, it is typical for capital-intensive firms like Chevron. The company relies more on stable cash flows than on maintaining large liquid reserves. The quick ratio provides a stricter measure of liquidity by excluding inventory. It remains below 1.0 across all years and declined to 0.64 in 2025. This indicates that liquid assets alone are insufficient to cover short-term liabilities. As a result, Chevron depends heavily on consistent operating cash flows to meet obligations. Asset turnover improved significantly up to 2022, reflecting efficient use of assets. However, from 2023 onward, the ratio declined, reaching 0.57 in 2025. This is due to rapid asset growth without proportional revenue increases. It indicates declining efficiency in generating revenue from assets. Chevron's debt-to-asset ratio remains relatively low across all years, indicating conservative leverage. Although debt increased in 2025, the ratio only rose to 0.13. This suggests that the company maintains strong financial discipline. Overall leverage does not currently pose a significant risk. Chevron's interest coverage remains very strong, even as it declines from over 60 times in 2023 to around 16 times in 2025. This means that the company can still comfortably meet its interest obligations. However, a downward trend reflects rising financial pressure. It suggests that the margin of safety is shrinking over time. Net profit margin peaked in 2022 at 15.1%, but declined steadily to 6.7% by 2025. This indicates that Chevron is earning less profit per dollar of revenue. The decline is driven by rising costs and normalizing oil prices. It reflects weakening profitability despite stable revenues. Return on assets increased significantly up to 2022, showing efficient asset utilization. However, it declined to 3.8% by 2025 due to lower net income and higher asset levels. This indicates that the company's growing asset base is not generating proportional returns. Overall, efficiency has weakened. Return on equity peaked at 22.7% in 2022, but declined sharply to 6.6% in 2025. This reflects both falling net income and an increase in equity from expansion. As a result, Chevron is generating lower returns for shareholders. This suggests reduced efficiency in using invested capital. The DuPont analysis shows that Chevron's declining ROE is primarily driven by lower margins and reduced asset turnover. While leverage has remained relatively stable, it has not offset these declines. This indicates that the company's performance issues are operational rather than financial. Efficiency and profitability are the main concerns. Chevron's key strengths include its strong revenue base, conservative capital structure, and ability to generate consistent cash flows. These factors provide stability even during volatile market conditions. The company's resilience allows it to continue investing during downturns. Overall, it maintains a strong strategic position in the energy sector. Chevron's weaknesses, however, are centered on declining profitability and efficiency. Margins have been compressing, and asset utilization has weakened due to rapid expansion. Additionally, the company remains exposed to volatile commodity prices. These factors indicate that growth is coming with trade-offs in performance. Overall, Chevron has moved from a period of strong profitability into a phase of expansion. While revenue remains solid, profitability and efficiency have declined. The company is investing heavily for future growth, but returns have not yet caught up. This reflects a strategic shift towards long-term positioning at the expense of short-term performance.
The VRIO analysis shows that Chevron's sustained competitive advantages are concentrated in its Guyana reserves, LNG portfolio, financial strength, and strategic joint ventures, as these are valuable, rare, and difficult to replicate. In contrast, capabilities such as refining, technology, and low-carbon investments only provide competitive parity because they are widely available across the industry.
This indicates that Chevron's advantage is still anchored in traditional energy assets rather than emerging low-carbon capabilities which may limit differentiation over time. Chevron's SWOT analysis shows that competitive strength comes from its integrated energy model, high-quality assets like Guyana and the Permian Basin, and its strong cash flow which together allow it to remain profitable even during price volatility. However, it is still heavily dependent on fossil fuels and is transitioning more slowly than competitors. The company can capitalize on LNG growth, digital efficiency, and government-supported low-carbon investments, but it faces increasing pressure from regulation, renewable energy adoption, and long-term demand shifts. Overall, Chevron is operationally strong today, but strategically exposed in the future. Chevron's value chain is built on scale, efficiency, and integration starting from global resource acquisition to large-scale refining and distribution through its logistics network. The company stabilizes revenue through long-term contracts and strong retail presence while support activities such as advanced technology, skilled workforce, and disciplined capital management enhance operational efficiency. This structure allows Chevron to maintain cost leadership and reliability in a highly competitive and price-sensitive industry. The competitive strength assessment shows that Chevron remains a top-tier energy company with strong performance in upstream assets, LNG, and financial discipline, but it's slightly behind ExxonMobil in scale and efficiency and behind Shell in energy transition positioning. While Chevron is highly competitive in traditional energy markets, its relatively weaker position in low-carbon development highlights a strategic gap that could affect its long-term standing. Chevron has two main strategic options. First, it can accelerate its transition into low-carbon energy, investing heavily in technologies like carbon capture and hydrogen to stay competitive in the future. Second, it can focus on its core oil and gas strengths, maximizing returns from high-quality assets like the Permian and Guyana while limiting transition investments. The recommended strategy is a balanced approach, maintaining strong performance in traditional energy while gradually scaling low-carbon investments. This allows Chevron to remain profitable today while preparing for long-term industry shifts.
And that has been Jaguar Consultancy's internal analysis of Chevron.